Would the housing prices continue to climb, or is there a housing market crash ahead? Having worked almost 2 decades in real estate, I'll share my personal outlook. Hello, I'm Becky Park, a real estate broker here in Southern California. Throughout my 18-year career in this business, I witnessed the boom of the early 2000s, the Great Recession that followed, and the growth ever since. There is a lot of speculation on the housing market nowadays as prices continue to rise. Some say that it will continue while others say that there's a crash ahead. Now, I am not an economist nor am I a psychic. But by seeing what's going on in my local market firsthand, day in and day out, I have my own predictions and I don't believe there's a major drop in prices anytime soon. In fact, it may very well be the opposite. Most homeowners have taken advantage of the low interest rates and have refinanced during the last couple of years, substantially lowering their monthly payments. How much were their payments lowered? Let's say that if you had a mortgage that was taken out in 2010 for $417,000, which was the conforming loan limit then, at 4.375%. At a 30-year fixed mortgage, your monthly payment would have been over $2,000. After 10 years of payment, your loan balance would have decreased to about $335,000. And if you refinance in 2020 with the interest rate of about 2.75%, your new monthly payment would have been about $1,300. Keep in mind that you have just added 10 more years by starting a 30-year loan again, but your payment has been reduced by more than $700 every month. With lower monthly payments, some homeowners can now afford to age in place, and this is one of the reasons why there are such low inventory in housing. Low interest rates are fueling buyer demand as buyers can afford more than before. With a drop in just 1% of interest rates, buyers can go up more than 10% on their loan amount and still maintain the same monthly payment. Now, a skeptical person might say that what goes up must come down, citing the Great Recession of the late 2000s. Remember, it was the unsafe lending practice that fueled the boom in the 2000s. Buyers only had to state how much they were earning on their mortgage application, and that was good enough for the lender. They could borrow up to 110% of the value of their property, with both borrower and the bank speculating that the housing prices will continue to rise. Many of them has taken out a variable rate mortgage and paid only the minimum due, increasing their loan balances as months went on. It was just like a credit card payment. When you pay only the minimum due, even though payments are made every month, your loan balance continued to grow. Some have taken out all the equity by utilizing HELOC or home equity line of credit. So when the mortgage lenders ran into asset issues and have stopped lending in 2008, these homeowners with high loan balances had no skin in the game and had no reason to hold on to their properties. Thus, the market was flooded with short sales and foreclosures. How's it different now? The government and the lenders have tightened mortgage guidelines. Lenders closely examine mortgage applications, usually verifying employment and tax returns through the IRS. Due to almost historically low interest rates, most buyers are choosing a fixed rate mortgage rather than a variable one. They are locked in at a low rate that will continue to pay down on their loan balances with each payment. As you may have heard, there usually are multiple offers on properties for sale nowadays. And when sellers have a selection of buyers to choose from, they most likely would prefer to go with an all cash or someone with large down payment because these buyers have less contingencies and a greater chance of closing. Just this week, I had submitted several offers on behalf of clients, and due to steep competition, most of them lost out to other buyers. It seems that buyers with 20% down are no longer considered as strong buyers. Consequently, the buyers who win the deal are usually the ones putting out a large amount of their own funds, having more skin in the game. And there is also stricter restriction on cash out refinances, so the homes nowadays are retaining most of their equity. Lastly, there's lots of money being circulated in the economy. With record high stock market yields, appreciations of cryptocurrencies, and multiple government stimulus policies, money is abundant. This may very well lead to an unhealthy inflation. And in an inflated market, it's wise to hold assets in material goods rather than in cash or liquid assets. Over time, real estate has proven to retain value. Do I think the housing market will crash? With the housing inventory and the mortgage interest being low as they are now, with lenders continuing to lend with caution, and with worries of inflation looming, I don't believe there will be a crash. I will leave you with the tour of this neighborhood. It was built in the mid-60s, with then the selling price in the mid-40,000s. Now it's selling in the range of 1.5 to 1.8 million. Sure, there were price fluctuations during its almost 60-year lifespan, but all buyers, no matter when they had gotten in, is on top now. Thanks for watching, and I hope all your real estate dealings are pleasant.